Are you feeling it? That fear of missing out? That nagging voice telling you to jump in with both feet as the market hits new all-time highs? That's FOMO. And if you are an investor right now, you are almost certainly feeling a twinge of it. I know, because it happens every single time. Markets do poorly and people sell out of fear and panic. Then markets come roaring back, hitting new highs just like they did last Thursday, and suddenly everyone gets impatient, scrambling to buy anything and everything. This is a classic investor cycle, and it's where costly mistakes are made. But if you could sidestep that emotional roller coaster, what if you had a clear, data driven perspective? There is a powerful saying: see the world as it is, not as you wish it would be. This means we have to look at the hard data, at what is really happening in the economy and the market, not what we hope will happen or what we see in the news. And that is precisely what we are going to do in this video. We will cut through the noise and the hype to give you a clear view of the investment landscape for the second half of 2025. By the end of this video, you will have a solid understanding of where we are, the potential paths forward, and how to navigate this volatile market to your own advantage. Here is what we'll cover. First, we'll dive deep into the US and international stock valuation to see what is expensive and what's on sale. Then, we will analyze the current economic situation, looking at the real numbers behind the headlines. After that, we'll explore future expectations and what the experts are predicting. And finally, and most importantly, we'll pinpoint the best opportunities and what to do next. Let's get started. Looking into the past, the S&P 500 looks very expensive. Trading at the forward P of 22, it only have one time in history where this forward P was higher. It was in the dot-com bubble, where you see at their peak a 25.2 forward multiple. Even in 2022, we had a forward PE of 21.4, and it looks very expensive at the time, just to look into it. But you can have a higher multiple if you have higher growth or higher quality. At the moment, we have higher quality in the S&P 500, better companies with higher margins, recurring revenue, for example, when you compare to the past. In the past, you didn't have higher percentage of the S&P 500 in tech. We had other companies that are not so high quality as we see right now. And in the future, we are predicting a lot of growth. Of course, if with AI, we are expect GDP growth above trend. So with that, of course, the S&P 500 multiple should be higher. But how higher should it be? Then we look to the average in the last 30 years. The average is 16.5. We are trading above 22, which looks very high. When you compare the top 10 versus the rest, the top 10 has a higher multiple, close to 30, when the 490 stocks in the S&P 500 are trading around 20 multiple. But in the dot-com, we have seen worse valuation, I would say. But right now, I would say S&P 500 companies were seeing higher multiples. They have earnings. They are growing faster than at that time. So is it a bubble? It's very difficult to say. But right now, we definitely see a very stretched valuation. Then we see the average. We are one standard deviation above the average of the 30 years. More data sustaining that. But is this a P that the S&P deserve? Right now we have better companies with higher margin and higher growth. So maybe this is deserved, but the future will tell us. Then we have equity valuations, regional, global. I would say forward P's on the world is above the average in comparing the last 30 years. In US, it's almost in the top percentile. In China, emerging markets, Europe, it's close or under the trend or the average, I would say. Right now, most of the markets has a discount when compared to the US market. Since 09, 010, we have seen outperformance from the US stock markets when compared to the rest of the world. But the US was at very cheap valuations at that time, and it was a recovery, so it makes sense. And then the GDP of US GDP has grown faster than the rest of the developed world. They have been getting better companies. Their stock market has a higher market share, I would say, with tech companies who deserve higher or higher valuations. So that's one of the reasons. So basically, it's not just outperforming or having higher valuation, but they also have higher quality, better growth. So they deserve a premium. But the question is always how much is this premium or how much this premium should be. Of course, the rest of the world, it's not very cheap. We have seen China very cheap in the beginning of the year, in the last 2 years. Europe was very cheap as well, and emerging markets. Right now, they are already recovering this year, doing better than the US stock market and recovering some of that underperformance from the last decade. But right now, the US remains very stretched in terms of valuations. Then we have consumer sentiment. Right now, it's look very low. This is something I have to say. I don't know how much is this true. This is data from JP Morgan, but right now, stock market is at all-time highs. Investors are very keen to invest in the future. They are very optimistic, expecting higher growth in the market, investing in AI, new trends. So I don't know. I don't know why this consumer sentiment is so low. In most of the times when we have consumer sentiment so low, it's when it's the best time to invest. Right now, maybe it is. Maybe we have a absolutely great growth in the next few years with AI helping GDP growth 3-4% in the developed world. Uh, in the emerging markets, we can have higher growth because of AI. This could be, if that happens, definitely stocks are cheap right now. But if you look into the past and believe GDP will grow for around 2%, maybe these valuations are very stretched. GDP growth, the trend is 2.1%. Right now, this growth is been the result of a lot of deficits in the US. They are spending a lot. Consumption as well is a big important part of the GDP growth in America. Then we see the GDP growth in the last quarter. First quarter of 25 was negative. We have seen a negative quarter since first quarter of 22, but in reality, this was a good quarter. If it was not a lot of exports and imports, I would say in this case it was imports because of tariffs. Importers get in advance and buy a lot of goods from other countries to not have the impact of tariffs. So that's why US invested a lot. That's why their GDP was negative in the quarter. If you see, for example, change in private inventories 2.6%, domestic purchase 1.5%, fixed investment from business 1.4%. So if it was not the net export being negative, it would be a 3%, maybe 4% GDP growth in the first quarter, which is very good and shows a lot of resilience in the US economy. Then unemployment and wages. Unemployment, it's at historically lows, around 4%. Bear in mind, we have seen the unemployment climb from 3.5% to 4, we are in progress. No, that's historically very low. Then we have seen wage growth of 4%, which is very good, very high, around the average, but above what we have seen like 2-3% in the last 20 years, I would say. So that's very good growth as well. Then we look at the federal finances. This is very important, deficit. That's what everything is talk about this new bill from the US government. One of the problems, it will increase the deficit, at least in the short term. So right now deficit is high. Debt has been increasing since 08, I would say. Right now it could be a problem if deficits goes to like 8 to 9% of GDP. It could be a problem. Dollar could collapse. I don't know. That's the fear that is in the market and in the dollar. But with this bill, I do really believe it will spur a lot of growth. You don't pay debt increasing taxes and reducing your deficit. You have to do like the US did in 1950s. They increased their growth. Their growth was very good. They have inflation around 3%, and with inflation around 3% and exponential growth, their debt reduced to almost 30% or close to 20 in the 80s. That's what the US should be. If they increase taxes, trying to reduce deficit, the growth of US economy will slow, and it will be a bigger problem for the economy. Right now, the tactic Donald Trump, the US government, is trying to do is to accelerate growth. In the short term, it will have higher deficit, but then with bigger growth, we can try to contain the deficit. Maybe tariffs will help, but what I really believe the US government wants to do is to have better conditions, better trade, invest a lot in their countries, and this bill is what will create all the things that could help to spur growth in the US. Then inflation. Right now, Fed is always aiming for the 2%. This might not be a solution. It's very hard, especially with the growth ahead. That might be some inflation. It will be difficult to have 2% inflation. But if we have 3% inflation and growth and wage growth above 3 or 4%, this could be very good for the US. Even though we have 3% inflation, we have wage growth higher, economy growing faster. This will reduce debt in the future, and basically it's what Ronald Reagan have done in the past, and basically it's the main goal of this US administration. So right now, inflation is at a very good point, down from 9.1% to 2.4. 2.4 doesn't look bad at all. We are close to the 2%, but there are fears that inflation, tariffs could spur inflation. That's true. If you have tariffs, the consumer will pay for that. In terms of tariffs, we don't know if it's the consumer will pay 100%, if it is the importer, the exporter. We know that these tariffs will have to be paid from the importers, exporters, the consumer or the stores, for example. It will be split between the four. How much share will have everyone, we don't know. But in the end, the consumer could have some inflation, or the exporter or the importer could have lower margins. We don't know how it will happen, but it will impact somehow inflation, and that's why the Fed is being so cautious, and it's not a bad decision in my opinion. Then interest rates. Right now we have real yields positive because interest rates are above the inflation, so we are at a good place right now, and we are expecting the Fed to cut rates in the future. Expectations to be 3% in the long run. They are not predicting they will go to 0% or 1% in the near future. As long as the economy are good. There are no reason to go to 1%, or Donald Trump wants Jerome Powell to cut 1%. We are too restrictive. Maybe we are, but the economy is doing very well. Of course, we are very restricted with inflation close to 2% and interest rates at 4.25, 4.5%. So we could cut some rates. Let's see what will happen in the future. But I think US economy is doing very well, even though they have high interest rate. But somehow it will be the goal is to cut in the future, so it will have lower interest rates in the near future. Then tariffs, a big problem. We say actually in April 8th, Liberation Day, we are assuming effective tax tariff rate of 30%. If you compare to history in the last century, it's probably the highest it has been. At least it was the first, when you compare the first tariffs that Donald Trump released. Right now, the effective tariff rate is close to 15%, which is historically very high as well. But we don't know how this will result, if we have more trade deals or not. Right now, there are no clear path. We don't know what will happen, but there are a lot of negotiation going on, and we have to wait a few more months to know more about it and how it will impact the US economy. But right now, it doesn't look so bad and the economy is doing very well. Then we look to the other side. Chinese consumer is still very low. We are seeing some in the first quarter. We have seen some earnings grow, signs of a starting recover, but we have to wait for the next quarter to see how the consumer is doing in China. But right now they have been facing a big recession in the last 2-3 years, so they are expecting to recover from that and starting growing again. But that's the goal of China, to increase their consumer, so they can start to export less and have a big consumer market like the US or Europe, for example. But right now they are being very cautious. In terms of growth in the next year, it is in the US they are expecting growth of 9% even with tariffs for 2025. 2026 14% earnings growth, and 2027 12%. This is big growth. If this happens, it will continue to be very optimistic for investors, and that's why this multiple on the S&P 500 it's so high of 20, 21, 22, because investors are expecting a big growth in tech, in AI in the next future, and GDP growing above trend. Profit margins are close to all-time highs. We have seen profit margins of 14% right now. We are going higher, and with tech having a higher market share in the S&P 500, S&P 500 margins are going higher as well, because tech has higher margin than other business. Then in terms of equity valuations, we have seen earnings growth mostly in India. US is growing very well in the last few years, and when you look to the future, this year 2025 we will see bigger growth on India and US, but for most of the world in 2026 we're expecting higher growth as well. 15% for India, 14% earnings per share growth in the US. Europe is expected to grow around 11%. China is expected to resume growth at 12%, then 9% growth in earnings per share in Japan. This has to be in some way GDP growth higher, consumer consumer confidence going higher as well, and AI creating a bigger profit for companies. So that's probably the trend we are seeing right now, and it's what data is saying to us right now. Then we have capex, a lot of investment in AI. We have seen the major scales are spending billions of capex. Alphabet, Amazon, Meta, and Microsoft driving most of the investments, and they are investing. And I do really believe these companies are very good investing, having high returns on investment on their capex. So if they are investing in AI, it's because there are a lot of synergy, a lot of value from these investments, and it's what possible will put the trend of GDP growth above what is expected, and we see probably a lot of growth in the next few years. Then, if you compare the last 30 years, we have seen periods of declining dollar, periods of dollar getting strong. From 08 until 2025, we have seen an outperformance from the US when compared to international. That's where the dollar is getting stronger. Right now, this trend is reversing, I would say. In the beginning of 2025, we have seen the dollar getting weak compared to the other currencies, and international, Europe, China outperforming the US. If this is a trend that will take just 1 year, 5 years, a decade, we don't know. Of course, this is gonna be we don't know the future, but it could be a trend. We could see, since the valuations of Europe stocks, Chinese stocks are very low, we could see some recovery in these markets. And US, it's very difficult for US to remain on top. Of course, they deserve a big premium on valuation because they are better companies. They have the best tech companies in the world. It's where the money is, their market is where everyone wants to be. And if they continue to innovate as they usually do, if their growth continues to be above the other developed markets, of course, the US and the dollar can have another decade of outperformance. But right now we have to wait all the factors. Then, US valuations. We have talked about stretch valuation. Right now we are trading at the current forward P of 22. If you analyze the other times where the S&P 500 has this forward P and see subsequent 1 year returns, we have between minus 20% to plus 40%. So there are a lot of dispersion. Of course, we are talking about 1 year returns. We don't know what will happen in 6 months, in 1 year. It's very difficult. We could see very good news. The US continue to grow very good, really above trend, good growth in GDP, and earnings per share of S&P 500 companies being above expectation. And you can see the S&P 500 hitting new all-time highs until the end of the year, and in 1 year it could happen, but that could be bad news. Tariffs impacting the economic growth, for example, big worries about the deficit, that all of that could trigger recessions or bear markets. But if you analyze the next 10 years, that's where at least it gets me worried. When you see S&P 500 trading at forward P of 22, for the next 10 years, we can expect returns between minus 2 and plus 2%, which is very bad. So should we invest in S&P 500? This is what history shows us. But during the past, US has been growing around 1-2%. Sometimes GDP is not growing. We have recession, crisis, and this all shows these times that have occurred in the past. Right now, we are facing an AI dominance. Tech, we have seen a lot of innovation. Tech is changing the world. For this not to happen, AI technology have to develop, innovate a lot, creating a bigger growth than the past trend. So if that happens, of course we can have good returns in the future in the S&P 500, and that's what investors are expecting, and that's the predictions of analysts. But if that don't happen, if you don't see growth above trend, earnings per share growing above trend, of course we'll have lower returns in the next 10 years. So that's just my warning. Then we see small caps. We have seen small cap valuations under the average of the last 30 years in US, in Europe, and in the UK, for example. So probably small caps have not gone anywhere. So why? Because discount rates are higher for small caps, and with interest rates so high, of course the discount rate has to be higher. So that's why small cap valuations are lower compared to historical average. And with interest rates going down, this could be very bullish for small caps and could be an opportunity in the near future for small caps. Then we look into asset returns expectations. In the coming 10 to 15 years, what we can expect higher returns per year. We say Japan close to 8%, Eurozone, even Europe. If they expect to, we expect Europe to grow above 10% earnings per share, for example, European stocks are very cheap right now. Then we have China. China valuation were very cheap. We have seen a lot of innovation in China in technology, robotics, for example. And this could be a big trend, and China is probably the only country that can compete with the US in this area. So if they could spur, if they can recover the consumer, for example, and their economy, China could have a bigger growth or a higher growth than the US. And then if that happens, we can have higher growth in the Chinese stocks, for example, and have a lot of returns. Then we have European core real estate expecting higher returns. It's very I'm very impressed about that, because real estate prices in Europe are very high right now. Then we have emerging market and US large cap. Even with that, they could expect around 5%. Of course, they have to beat expectations so the returns can be positive in the next few years, and the economy has to do well. If there is recession, crisis, bear markets, that all could impact the future returns in the next 10 to 15 years. And that's all the data that I think it's very important to share with you guys. So, to wrap it all up, what have we learned today? While the overall US stock market, especially large cap tech, appears stretched in terms of valuation, this doesn't mean there aren't incredible opportunities for the savvy investor. We have seen that international market, US small caps, and out of favor sectors like healthcare and defensives are presenting compelling value. Expectations for the coming year are undoubtedly high, largely fueled by the transformative potential of artificial intelligence, which could justify some of the loftier valuation we are seeing. The US economy, despite some headwinds, remains in solid shape, supported by what many consider one of the most pro-business administrations in recent history. Those headline-grabbing tariffs, they might just be a strategic move in the great game of global trade negotiations. The key takeaway is to remain disciplined, focus on quality, and diversify your portfolio. Don't let FOMO dictate your investment decisions. Now, I want to hear from you. What are your biggest concerns for the second half of 2025? Are you buying, selling, or holding? Let me know in the comments below. And if you found this video valuable, please give it a thumbs up and subscribe to the channel for more in-depth, data-driven investment analysis. Thanks for watching, and I'll see you in the next one. This video is for informational purpose only and should not be considered financial advice. Always conduct your own research and consult with a qualified financial advisor before making any investment decision.